Tell us what's going on with these jobs numbers. They certainly surprised me on Friday.
Yeah, I was looking for a number smoothing through the shutdown issues of north of 2, and getting something north of 3 was really just miraculous. And to put it in perspective, we went back and looked at first quarter GDP numbers all the way back to 1990. We found that they averaged north of 3%, the GDP, when you started with the first month north of 300 and a quarter. And so it's really, really good news. It's a strong sign that the momentum that we had last year of 3% growth is continuing into this year. And I think that, markets had this period where they're very nervous about, well, is the growth going to continue? Is it not going to continue? But that 300 number, I think, suggests that we're really going to pretty much count on 2, 3, 4, 5 more quarters of 3% growth before anything starts to kick in that looks slow.
Well, and on top of that, there was some indication maybe there's still some slack in the market, because you see that job participation rate continue to eke up, which I know is something that you and the president had made a priority of.
Yeah, that's right, especially the president. And to put it in perspective, that when I came into the Council of Economic Advisors, one of our first jobs is to do the forecasts for the next 10 years. And we looked at the forecasts that the previous CEA had done, and they were basically losing about 0.5% a year of growth because of declining labor force participation. There was a steep downtrend that they projected would continue. We, in our first forecast, suggested that it might, soften a little bit, the downtrend. But really, it surprised even us on the upside. And I think that what we're seeing is, basically a really strong economy with solid wage growth that I think is going to improve this year. And we're just bringing people in off the sidelines because there are more job openings than there are available workers.
What about that solid wage growth? Because those were a bit softer, actually, last month. What do you make of that?
Well, no, we're coming in north of 3, and inflation numbers are south of 2. So we're growing. Real wage growth is maybe 1.2% or 1.4%, somewhere in there. And that's serious real wage growth. Don't forget that the talking point that everybody, talking about wages have used for years is real wages have been stagnant for a decade or 2 decades, right? And so to have real wage growth, we want it to be higher, but to have it north of 1%, then that's, basically a serious accomplishment. The question then is, where does it go from here? And I think that what we're going to see is that nominal wage growth, which is a little bit north of 3, is going to spike to over 4% this year because of all the capital spending that came in last year because of the tax cuts. And so we expect real wage growth is going to accelerate. The reason you didn't see it all happen last year is that wages adjust slowly. So I don't know about you, how many times a year does your wage adjust? Probably about once, right? No, it's about once. Yeah, you negotiate,
in a good year, Kevin, it goes up once.
Yeah, that's right. But the point is, so people are now watching their firms have all the success and higher profits, and then they're going to their boss and say, well, when I get my salary adjustment, why don't we jack it up a little bit? And we're going to start to see that even more in the data as the year goes forward. And so at this point in the cycle, to have a capital spending boom with a very, very tight labor market, we'd very much expect to see wage growth going north of 4.
So, Kevin, we had a 35-day government shutdown. And as I understand it, in the job numbers, basic job numbers, it really wasn't reflected because federal workers wouldn't have put in for unemployment at that point. But are you concerned about it coming back? As the president yesterday's announcement said in his interview with CBS said it could come back. Would that affect our GDP growth?
Well, I definitely, my staff was mostly furloughed, and, I used to joke at CEA that I get paid to worry, but for about a month there I get not paid to worry. And I absolutely, don't want to see people have to go through that again. And I don't think the president does, but, he's got very strong objectives that he's hoping to, achieve between now and next Friday. As far as how they affect the data, here's the way to think about it. On the payroll side, they basically ask the employer, how many people were on your payroll. And so since the government was ultimately going to pay those workers when they came back, then they counted them all as being on the payroll. But on the household side, they asked people, hey, were you working last week? And about half the people who were furloughed said no. And so the unemployment rate went up above 3.9 to 4%. Likely entirely because of the shutdown. And so we expect that will reverse itself next month, assuming that the shutdown doesn't start up again.
Kevin, one thing I always want to talk to you about is productivity and capital investment, which are related as I understand it, although the relationship may not be exactly one-to-one. And I must say, I went to the Bloomberg and took a look and thinking that capital investment had come off, and it may have come up just a little bit in the last month or two, but overall, we'll show this, it's gone up under President Trump, perhaps in part because of the tax regulations. Is that what you're seeing? But are you seeing it show up in productivity yet?
Yeah, we're definitely seeing productivity go up as well, and that's one reason why wage growth doesn't necessarily have to be inflationary. So a lot of times in previous cycles, what would happen would be you'd get the unemployment rate down, say maybe around 4, and then you didn't have a productivity spike because of capital spending, and so then wages would go up, and the Fed would look at that and say, oh, we got to step in front of that and slow down the inflation. But in this case, what's happening is we're making workers more productive. Their wages are going up, probably with a lag in response to that higher productivity. And so it's less of a threat in terms of overall inflation.
Kevin, one of the things we hear time and again from economists is if you look for a cloud on the horizon, it has to do with uncertainty over trade. That's the one thing that particularly CEOs are taking a look at. They might hold off on capital investment because of that. What sort of analysis are you doing about the uncertainty about trade, particularly with China, not limited to China, and its possible effect on economic growth? What are you telling the president?
Right. Well, there's a big literature that shows that uncertainty can be a negative for the economy. And the one thing I would say to people in markets who are worried about uncertainty and its effect on markets is that whatever the uncertainty effects are, they would have had to have been a lot bigger last year than they're going to be this year. We're moving things forward. I think that we've had a lot of productive conversations. I think the hope is that, especially if the deal with China comes through, that there'll be a lot of positive resolution of uncertainty. Last year, you just had uncertainty. And so I think that in terms of trade, last year we had 3% growth even with the trade uncertainty. This year, I think that the uncertainty is an upside risk. I think the thing that's a downside risk is just policy uncertainty. The Democrats would love to take all these policies that we've engaged in or enacted that make capital spending boom and make the economy boom, and they'd like to reverse them. And I think if markets start to look ahead to a world where the policies might get reversed, then that might give them a little bit of a scare. And so I think that the real risk of the outlook for me right now is that, really far left policies like, wealth taxes or, 90% marginal rates, the kind of things that are being bandied about, if those proposals start to be taken seriously by markets, then that's going to provide a lot of risk.
Finally, Kevin, when the tax reforms were enacted, one of the issues was the deficit and the growing deficit. We're seeing more and more borrowing by the federal government, something I know that you are concerned about. When we put the tax effects in, what we were told by the administration is it will make up for itself in increased revenue. That, in fact, it will not increase the deficit overall. I'm not seeing that yet. Are you? And where are you seeing it?
Well, over a 10-year horizon, you start to see stuff like that, right? So imagine if GDP grows 1% more a year for the next 10 years, then 10 years from now it's 10% higher, and right now the CBO forecast for nominal GDP 10 years from now is about 28 trillion. So you got almost, 3 trillion more GDP just in that 1 year alone. And so it's very easy to make the numbers work out, provided that the growth persists. And so we've had the first year of high growth, and the revenues actually were a little bit lower, I think, than the JCT last forecasted, in part because there was so much capital spending and expensing that cut corporate revenues some in the first year. But that'll have big payback in the future as we grow more and those factories, turn the lights on and create output.
So no impetus from the White House right now at fundamental tax reform, that is to say, eliminating some of the deductions, really streamlining the thing? Some people have urged that.
Well, the president has said, he's definitely said that he's concerned about the deficit. He's instructed the cabinet agencies to put forward a budget, which we'll be coming out with in a few weeks. In fact, we don't have an official date yet, with 5% across the board cuts in cabinet agency spending. And so he's definitely got his eye on the deficit and coming forward with positive policies to address it. But yeah, I don't think that the tax cuts, if you look at those, that you would have to say that the evidence is that they're not going to provide a lot of dynamic feedback. In fact, it's the opposite, right? I mean, everybody said the GDP growth in 2018 would be around 2%. It was 1.6 in 2016. And, I think that when we get the fourth quarter, we're going to be north of 3 for the year. That extra percent is, a new base that we can grow off of for the next 10 years that's going to provide a lot more revenue.